No, we'll just keep buying, right? The price is going to go up. It's going to get exponentially harder, and the price is going to go up exponentially higher, and we'll just keep buying. And at some point, if we get to 5% of the supply, Bitcoin's probably going to be $1 million a coin. And if we get to 7.5% of the supply, Bitcoin will be 10 million a coin. And then we'll be, if I'm lucky enough to grind to 10% of the supply, Bitcoin's going to be 50 million a coin, and someone will be whining that whatever, we have too much Bitcoin, but other people will have $400 trillion of wealth, so, our view is it's a ratchet, and we're just going to keep cranking on the ratchet, and there's massive leverage here. And I think everybody's winning if we do that.
Bitcoin is on a trajectory that could see it reach $1 million per coin, and that's just if 5% of its total supply gets locked up. Double that to 10% and the math points toward an astonishing $50 million per coin. That's the bold projection from Michael Saylor, executive chairman of MicroStrategy. His argument is simple. Bitcoin's supply is fixed, the rules are transparent, and every coin accumulated makes the next harder to get. This isn't a speculative pump, it's scarcity by design. As more of Bitcoin's supply gets taken off the market, its value naturally rises. Saylor emphasizes that this isn't driven by hype, but by mathematical certainty. If a small percentage of the supply gets absorbed and held, the pressure on remaining supply accelerates price growth. It's a system where those who accumulate early have the greatest leverage, and every purchase today makes future access more expensive. Saylor's strategy? Stack aggressively. He sees Bitcoin not as a short-term trade, but a long-term power shift. In a world of infinite fiat, Bitcoin offers finite opportunity. According to him, those who act now aren't just chasing profits, they're positioning themselves for systemic change. Stick around until the end of the video to hear more of Saylor's bold predictions and why he believes Bitcoin is the ultimate asset for the future.
Stop. You don't have time. Don't miss out this 2025 bull run. Educate yourself first ahead of the crowd. We have created the ultimate step-by-step crypto cheat guide that will guide you this bull run. Unlock the secrets of crypto and make smarter investments today. Now by clicking on the link below to get your exclusive copy just under $10.
To equate Ethereum and Solana to Bitcoin is like equating balsa wood and clay bricks to steel. And yeah, you can also lever them, but you can lever balsa wood, but levering, you can build lots of things that are steel containers, and you can use rubber bands, but it's not the same thing. So there's a reason that securities law prohibits public companies from capitalizing on securities. And the reason is because you can lever a security 100 to 1. And so if I actually issued 1% of the float of a security, I could take $10 million and create a $10 billion market cap company. And so you would literally have 10 million in the float, and then you would tell yourself you had $4 billion of collateral on your balance sheet after you levered it up, and then you would start to act that way. And then when the bottom of the structure comes crashing down, you get a situation like Terra Luna or like FTX. Both of those were examples of companies levered on proprietary tokens. And so Solana and Ethereum are they may not be securities, but they're definitely tokens. And as tokens, they're not a commodity. And so I would caution anybody listening here against levering up on a token, right, or a proprietary asset, because it's kind of like trying to copy my skyscraper and doing it with bricks or with aluminum or with copper, right? The entire thing's going to buckle, and lots of people are going to die, and it's going to be a catastrophe, and you're going to take out the entire city block. And that did happen. It has happened over and over again in the crypto world. Happens all the time. People think that they discovered leverage, and what I'm doing is not an intelligent or brilliant idea because I'm using leverage. The reason it works is because I'm putting leverage on steel. I'm doing it with the right material. I'm actually using a product which doesn't deflect, right? And so Bitcoin is a crypto asset which does not deflect. That's why you can lean on it with $10 billion of leverage or $100 billion of leverage. And if you do the same thing with FTT token or Luna or pick your favorite token. If you do the same thing, you're going to find it will buckle at some point. And when it buckles, there's going to be catastrophe. Look, I think the key with Bitcoin is the protocol itself is stable. Nobody can censor the network. It's distributed enough. No one can censor or corrupt the protocol. No one can control the price. It is sufficiently decentralized and global that no company, no country, no capitalist has enough influence to be able to put it at risk. And it is the one thing that we can all agree on in that regard. So when we go to the question of companies adopting the Bitcoin standard, Jeff, I think the primary guiding principle is you want to do this well. The question is, are you going to adopt Bitcoin as your primary treasury reserve asset? That means like flip 90% of your long-term capital to Bitcoin, right? 5%, 2% doesn't really do the job. You really want the vast majority of your long-term capital. Substantially, you want 100% of long-term capital to be in Bitcoin. And I define that as you've got working capital. If you need $50 million in working capital, then you hold that in the fiat currency of your liabilities. Everything else is long-term capital. You flip that to Bitcoin. And then after that, right, you've got two parts of the business. You've got the operating business, and then you've got the treasury, or you've got the balance sheet part of the business. I don't have any advice to people on the operating part of the business. Every single operating business is different. The only thing you can say is that 0.1% of operating businesses are good, and 99.9% of operating businesses struggle at all times. I mean, that's the big piece of wisdom I have for you. If you feel like your business is under pressure and is difficult and challenging, that makes you one, of the 99.9% that feels the same way. The only people that don't feel that way are the ones that run the monopolies, that are either state-sanctioned monopolies or digital monopolies, and everybody else struggles. And so there's no simple unlock there. I'm going to tell you, get a monopoly from the government of the local country you operate in. That's my suggestion. Or maybe you're lucky enough to be Apple or Google or Microsoft. But if you're not, then the operating business is all about finding a monopoly. And it's not easy to fix that. It's pretty obvious, right? It's quite obvious. It's hard to be better than Amazon or Microsoft or Apple. So the real advice is focus upon the balance sheet, where it is very easy to be better than the US dollar standard or the fiat standard company. So that's the part of your business you can fix. You can fix your balance sheet. And most people don't. Like, most people don't focus on that. They put 98% or 99% of their effort into their P&L. And they're basically pouring 99% of their focus and their energy in a losing cause, and they're not going to win. And they're putting 1% into their balance sheet, where you're 99% likely to succeed on the balance sheet under the Bitcoin standard, and you're 99% likely to fail in the operating business on the fiat standard. But conventional wisdom is to focus on the operation and dismiss the balance sheet.
Ethereum, Solana, Luna, and FTT, these tokens are built on hype, not fundamental strength. You can inflate their market caps and use leverage to push prices up, but when the pressure mounts, they crumble. The story repeats itself. Terra collapsed, Luna collapsed, FTX collapsed. The problem? The foundation was weak from the start. Michael Saylor explains that Bitcoin doesn't face this issue. It doesn't rely on creative accounting or economic games to prop it up. The supply is fixed, the network is decentralized, and the protocol stays rigid, unchanging to suit anyone's agenda. This is why Bitcoin can withstand significant pressure. You can layer billions in leverage on Bitcoin, and its structural integrity remains intact. The same can't be said for the others. They were never designed to hold up under such strain. This is why serious capital avoids these soft assets and moves to Bitcoin, which can endure when everything else falters. It's not about gambling, it's about choosing what stands the test of time. Now let's dive back into more of Michael Saylor's insight.
I think all the rehypothecation experiments have all crashed and burned over the last decade. So I don't think they've got a good track record. I think that all the layer 2 type applications, they're always very interesting to programmers, but no one's figured out how to scale them without some technical instability. You run into massive amount of technical problems, massive amount of security issues, and then massive amount of regulatory issues to do that. So I think that the best way to generate yield and generate a return is you buy the Bitcoin, you hold the Bitcoin in cold storage, and then you sell equity at a premium. That's the risk. When you're selling equity at 3 times NAV, you're literally selling dollar bills for $3 all day long. You have a money printer. Okay. It's a risk-free money printer. So why would you do anything else if you could literally sell dollar bills for $3 all day long? And so the creation of high volatility, high optionality public equity, and then bonds, convertible bonds, fixed bond, corporate bonds, or preferred stocks. All of those are by far the best, lowest risk way to generate yield off of the underlying Bitcoin. They solve the compliance issues, right? Because you're selling a compliant security on a compliant exchange, so you don't run into this issue where you did something really cool that is illegal in the state of New York, right? Or it's illegal somewhere. So they solve the compliance issues, and then they also solve the scale issues. If you have a good bond, someone will buy. I've had meetings where someone gave me a $500 million order after the meeting.
Yeah.
Like, can you sell $50 million of something in 20 minutes? I've sold $250 million of something in 20 minutes. So if you want to scale the business, if you want it to be compliant, if you want to generate substantial material yields, then I think you want to do it by issuing securities. And of course, there's one ladder of securities in Japan, which are different than securities in America or US, which would be different than Brazil. It would be different in France, different in the UK, different in Germany, different in Switzerland, right? Different everywhere in the world, in Canada. So basically, securitizing Bitcoin in some kind of wrapper, it could be as simple as, okay, here's an ETF, but it could be here's a 2x ETF. It could be here's a Bitcoin-backed bond ETF. It could be here's the bond. It could be something else. It could be here's the option. Those are all the most compelling ways. I think the reason that certain people in the crypto industry don't embrace it is they don't have the technical financial capability to create these compliant instruments in these markets. So they go for the crypto token approaches, or quote unquote crypto native. But the bottom line is, the crypto native approaches are only 1% of the opportunity, and they're 100 times as hard. And so the real money here is going to be made by more conventional financial firms that are going to issue $100 billion worth of Bitcoin-backed bonds, and then $1 trillion of Bitcoin-backed bonds. And then when people go, oh, well, $1 trillion, I guess is saturated, then they're going to issue 10 trillion of Bitcoin-backed bonds. And people watching are going to complain that it just seems too simple, right? It's like, and what I see a lot, Jeff, in this market is I run into crypto people that have been in the business for a decade, and they have very complicated ideas that don't work.
Yes.
And I offer them a simple idea. I'm like, here's an idea. You're a public company, sell your equity, buy the Bitcoin. They're like, no, that'll never work. Okay, well, I guess it might work. Well, what if the Bitcoin goes down? Well, blah, blah, blah. Okay, I guess it worked. And you know what the latest pushback is, Jeff?
Let's hear
The
it.
latest pushback is, well, it worked for you, and it worked so well that you're the winner, and there's no room for another company to do it in the market. So we literally went from, I don't think it'll work at all, it did. Oh, it worked too well. That's my excuse for why I'm not going to do it.
Every complex attempt to squeeze yield from tokens has ended the same way: failure. Whether it's rehypothecation, token staking, or layer 2 experiments, they've all collapsed under the weight of their own instability, security issues, and regulatory hurdles. The hard truth is that these gimmicks just can't scale without breaking. According to Saylor, the most straightforward way to generate real, compliant returns on Bitcoin is to hold the asset securely and sell equity or debt against it. Public companies can issue stock at a premium or sell bonds backed by Bitcoin. These aren't risky experiments, they're proven financial tools that work. They tackle the compliance and custody issues and scale effectively. This is how you move hundreds of millions in minutes, not through clever tokenomics, but through simple, secure instruments the market already understands. The complex ideas keep failing because the simple approach continues to win. For more Daily Dose Crypto News, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.